Hello everyone, and welcome. Today, we're diving into a crucial topic for any trader or investor: news events and market sentiment. We'll explore how understanding economic indicators and the mood of the market can give you a significant edge. Let's get started. First, let's look at our roadmap for this session. We'll begin with an overview of what economic indicators are. Then, we'll drill down into the key ones: inflation, employment, GDP, GNP, and business environment indicators. We'll learn how these indicators affect market sentiment and then see the practical market reactions in forex, bonds, equities, indices, and commodities. We'll wrap up with some case studies and the key trading implications you can take away from all this. So, what exactly is market sentiment? Think of it as the overall attitude or mood of investors toward a particular market or asset. Is the crowd optimistic, bullish, or pessimistic, bearish? This sentiment isn't random, it's driven by a constant flow of news, economic data releases, and, perhaps most importantly, expectations about the future. This collective mood directly affects price direction, volatility, and liquidity. For example, when a major report like the non-farm payrolls is released, you can see this sentiment shift in real time as prices react violently. At the heart of these sentiment shifts are economic indicators. In a nutshell, these are statistical measures that act like a report card for an economy's health. They give us a snapshot of performance. For traders, they are vital because they help us anticipate what central banks might do next and where the markets could move. Let's talk about one of the biggest drivers: inflation. The two most watched indicators are the Consumer Price Index or CPI, which measures the average price changes for a basket of consumer goods and services, and the Producer Price Index or PPI, which tracks changes in input costs for producers. The impact is straightforward. High inflation typically forces central banks to tighten monetary policy, meaning, they raise interest rates to cool the economy down. This expectation of rising rates usually leads to a stronger currency but weaker bond prices. Now, let's get specific about how inflation sentiment plays out across different asset classes. In the forex market, rising inflation often strengthens the domestic currency, as investors anticipate higher interest rates, which attract foreign capital. In the bond market, it's a negative. Prices fall because yields need to rise to compensate for inflation. For equities or stocks, it's a mixed bag. Stocks may fall if investors worry that higher costs will shrink company profit margins or that rate hikes will slow the economy. And commodities often rise, as things like gold are seen as a classic hedge against inflation. Next up, employment. The headline act here is the U.S. non-farm payrolls, or NFP, a monthly measure of job creation excluding the farm sector. Alongside it, we watch the unemployment rate. The general impact is that strong employment data creates optimism about economic growth. This is generally bullish for equities and can lead to a stronger currency. Breaking it down by market, strong jobs data, like a high NFP number, frequently leads to currency appreciation. For bonds, yields tend to rise on growth expectations, which means bond prices fall. For equities, the reaction is generally positive, unless the data is so strong that it stokes those inflation fears we just talked about. For commodities, the demand outlook improves with higher employment, as more people have jobs and income to spend, which can be positive. As you can see from the chart on this slide, a major employment release can cause massive moves, like this 100-pip swing in a major currency pair in just 5 minutes. Now, onto the broad measures of economic size, GDP and GNP. Gross domestic product measures the total value of all goods and services produced within a country's borders. Gross national product is similar but also includes income earned by domestic residents from overseas investments. The key takeaway is that higher GDP growth signals a strong, expanding economy, which naturally boosts market confidence. You can see a real example here from a 2022 U.S. GDP release, where the actual figure came in below forecast, causing the dollar to depreciate against the euro. Beyond the hard numbers, we also have indicators that gauge the feelings in the economy. The Purchasing Managers' Index, or PMI, is a superb leading indicator that gauges business conditions in manufacturing and services. A reading above 50 indicates expansion. Then there's the Consumer Confidence Index, which measures how optimistic households are about their financial situation. Positive readings in these indices are great for boosting equities and overall risk sentiment. Let's bring this all together with a practical case study. Imagine this scenario: U.S. CPI data is released and it's significantly above market expectations. Here's the typical chain reaction. The USD strengthens instantly as traders price in a more aggressive Federal Reserve. Bond yields spike and prices fall on the expectation of higher rates. Equities might sell off initially because higher rates make borrowing more expensive and can slow down corporate earnings. And gold, a classic safe haven, often rises as investors seek protection from inflation. Now, let's focus on a specific pair, pound sterling to US dollar. In this scenario, you would likely see pound sterling to US dollar go down. Let me explain why. First, a quick primer on how trading a currency pair works. When you trade pound sterling to US dollar, you are essentially betting on the relative strength of the British pound against the US dollar. The pair is quoted as how many US dollars, the quote currency, it takes to buy 1 British pound, the base currency. If the pair goes up, the pound is strengthening relative to the dollar. If it goes down, the pound is weakening relative to the dollar. So, why does it fall on strong US data? It's all about relative interest rate expectations. The surprise high US inflation data makes traders think the Fed is going to have to raise interest rates more aggressively to fight this inflation. Higher interest rates in the US make dollar-denominated assets more attractive to global investors, as they can get a better return. This increases demand for the US dollar. At the same time, this data point is purely about the US economy. It doesn't change the outlook for UK interest rates in this moment. So, while the demand for dollars is shooting up due to expected US rate hikes, the demand for pounds remains unchanged in this immediate reaction. When the dollar gets stronger all on its own, and the pound doesn't, the value of pound sterling to US dollar falls. The dollar is now more expensive relative to the pound. This is a perfect example of how Forex is a relative game. It's not just about one currency, but how it stacks up against the other. So, what are the key lessons for you as a trader? Always be aware of the economic calendar. Know when major indicators are being released. Remember, the market reacts not just to the data itself, but to how the data compares to expectations. A good number that was already expected might have no effect. For the best results, combine your fundamental analysis, what we've discussed today, with technical analysis. Using them together greatly improves your accuracy in predicting market moves. To wrap up, economic indicators are the fundamental building blocks that shape market sentiment and, in turn, guide asset price movements. By understanding how inflation, employment, GDP, and business sentiment interact and influence different markets, you move from simply watching prices to anticipating them. Thank you for your time, and I wish you happy and informed trading.